Hi, Brock VandenBerg, President of TaliMar Financial and Fund Manager for TaliMar Income Fund. A common question that I'm getting these days is how will the recent rise in the 10-year Treasury impact the return of our mortgage fund? To start, the 10-year Treasury is a government bond issued by the U.S. Treasury with a yield that reflects the return investors' demand for lending money to the U.S. government. Imagine it's paying out what investors feel is the risk of lending to the U.S. government. Now, the 10-year Treasury is a benchmark for interest rates across various financial markets, and it really reflects investor expectations about inflation and future economic growth. If the rates go higher on the 10-year Treasury, that typically means that people perceive some type of future risk in the economy. Now, while the private mortgage funds are not directly tied to the 10-year Treasury, and I've done a couple of videos about this, it does influence it somewhat. However, the bigger influence on the return of a private mortgage fund has more to do with the availability of capital in the marketplace funding the same type of loans that we're funding. So right now we see a large amount of capital entering the marketplace, especially from larger private equity funds looking to enter the market, which has created some downward pressure on what we can price. Now, a lot of these competitors do borrow money to lend money. So if their cost of capital goes up, they need to charge higher rates for the loans that they're doing. So in those cases, we could see some upward or ability to increase and be more flexible in the type of pricing that we can charge. I can't tell you at this moment with certainty what we're going to see here in the near future, but if we see a long-term sustained higher rate in the 10-year Treasury, one could assume that we are going to be in a position to charge higher for our loans that we're funding. Now, it also have to take into consideration, and this kind of happened 2 years ago when rates did make a increase considerably, is the ability to replace lower rate loans in the portfolio with higher rate loans. And the way that usually happens is, first and foremost, those lower rate loans pay off. And so you can replace those lower rate loans with higher rate loans. That right there will definitely benefit the return to the investor. The other way you can increase the return by getting loans out is actually selling loans and then taking the proceeds from the sale of that loan and bringing in or funding new loans at higher rates. And again, that's something that we employed 2 years ago when rates did go up considerably. Probably is not going to be a strategy that we're going to use this time around because, again, I don't anticipate seeing a considerable increase in what we can charge here in the short term. Thank you for listening to the video. Hopefully you found something interesting from it. If you liked it, give it a like. Remember, subscribe to our YouTube channel. Post a lot of great content about the private lending industry. If you have any comments about what I'm talking about, feel free to add a comment. I'd love to respond to those comments. Thanks again for listening and check out our other videos.